All right. Good day, everyone. Thank you for joining us today. My name is Herman Warren. I serve as the network director for the Economist Corporate Network, and it's my great pleasure to facilitate and moderate today's session. We're joined today by members of Corporate Network, which is the networking and advisory side of the Economist Group, as well as a number of guests. For those of you not familiar with Corporate Network who'd like to learn more, you're welcome to visit the URL, which is contained at the bottom of the slide, which should be showing on your side of the screen, or of course to get in touch with me directly. Today's session is the second edition of our regional strategic forecast, where we take a kind of time to pause, reflect, think through the state of the global economy, the outlook for the global economy, and then click down into key regions in the world, and we'll have a very focused discussion specifically centered on South Africa. And it goes without saying that this year has been significantly impacted, to put it mildly, by COVID-19, which has unleashed a tsunami wave of impact washing over the global economy and hitting on both sides of the equation, so to speak, both the demand and the supply side. The virus had its origins in China, in Hubei province, the epicenter in Wuhan, causing a lockdown, and that really foreshadowed what would happen in the rest of, as unexpected as it was, in the rest of the global economy. And on this slide, what you see is the impact on global GDP by country and geographic area. China very much further down the curve, and in fact, it will be the only large economy to grow in 2020, but the rest of the world still in the grips of the impact of this novel virus that most of us knew nothing about just 8 or 9 months ago. Just in fact, today there were reports of new restrictions coming into play as another wave, if you will, of the virus hits the UK, and restrictions being imposed, or stricter restrictions being imposed in the English in England. So if I can just move down. So what has the virus caused other than a contraction in GDP? The demand and supply side shocks has led to a significant response by governments around the world, fiscal and monetary, and an explosion, if you will, of debt. Debt to GDP levels have gone up. Trillions have been added alone to the balance sheet of the US government. And a big question is, well, how is this debt contended with? Does it potentially lead to inflation? Does it lead to sovereign defaults? Does that have systemic risk to the global financial system? COVID-19 has also, as was outlined in The Economist, perhaps delivered the third body blow to globalization. The first body blow coming during the global financial crisis over a decade ago. The second coming by way of trade tensions, most pronounced perhaps between the United States and China. And it's also accelerated or amplified a number of trends. So clearly, there's been a quicker adoption of certain technologies. This event, all things being equal, without COVID-19, would be a live event, not a virtual one. But things like e-commerce, remote working, and so on have all been impacted or pushed to the forefront as the result of the impact of this virus. The second impact is encapsulated in that goodbye globalization cover page. Supply chains will have to be recast. The trade wars sped that up, but there are companies looking at how they buttress themselves and protect themselves as the result of access to supplies being curtailed, by borders being closed, and so on and so forth. there's also the risk of a further rise of concentration, because those companies that will survive out of this will have the strongest balance sheets and perhaps the best connections to the power brokers to access relief funds and so on. So this age that we're in foreshadows a restructuring, if you will, pregnant with risk and also opportunity, but underscored undoubtedly by uncertainty. If I can just move on. And this slide kind of demonstrates that quite significantly. Cross-border investment could drop by 30 to 40% this year. Businesses and consumers are uncertain by the impact of this virus and what it may mean for their industries, their business models, and their prospects going forward, both on the positive side and the negative side. But undoubtedly, as we see, particularly on the right side of this graphic, that uncertainty and anxiety has injected a bit of reluctance to invest going forward. Not to steal my colleague's thunder, but going back to a point that I made earlier or alluded to, this is going to be a very tough year economically for the global economy. At the Economist Intelligence Unit, we view 2020 and 2021 as lost years, where GDP in those 2 years will not equate to GDP in 2019, and some countries will take longer to recover than others. And on the bottom right of that slide, I'd like just to bring into focus one country in particular, which is South Africa. South Africa is set for a period of perhaps 5 lost years, where 2019 GDP levels will not be equaled until the fourth quarter of 2024. So tough times ahead for South Africa. And I think importantly, particularly for those of you who are based in South Africa, have an interest in the region more generally, given how large South Africa plays in the economic mix of sub-Saharan Africa, very important to understand the choices that the country faces to right the ship, so to speak. And we're going to spend some time today unpacking that with the speakers who have been assembled. On this slide shows who will be sharing the virtual stage with me today. Simon Baptist, the Global Chief Economist and my boss at the Economist Intelligence Unit, Ann Bernstein from the Center for Development and Enterprise, and Kas Kuvadia, who's the CEO at BUSA. We want to make this session as interactive as possible. So I encourage everyone who is logged in today to make use of the Q&A function. Pepper us with your questions as we go through the various presentations, and we'll attempt to engage each one of those questions that are posed either during or post the session. As a first or a second kind of underlining of the intention that I certainly have to make this as interactive as possible, I'd like to direct you all to Slido, which is an interactive platform which hopefully no gremlins will emerge from the system today, and we can incorporate in and get some real-time feedback from those who are logged in. So if you can, perhaps you switch a tab and use your browser and go to, or add a tab, or use your phone and go to slido.com. You'll be prompted to put in an event code, and that event code is R as in Ronald, S, F as in Frank, underscore AF as in Africa 2. And if you can go there and do that, I'll give everyone about 30 seconds. I'll pose the first question to everyone. And the first question I'd like to pose is, what are your biggest areas of global concern? What topics are you most gripped with when it comes to managing and leading your businesses, not only now, but beyond the pandemic. And if you can just type in some of the thoughts that come to mind, or words that encapsulate that very briefly, that would be wonderful to see. So exchange rates, big issue, and I think Simon may touch on some of those elements of exchange rates, particularly relative to reserve currencies like the dollar. COVID fallout goes without saying. Is it the end of oil? COVID, surprise, surprise, looms large. Currency comes in again. I'll just wait for a couple of more responses there, and then we'll move to the next question. Anyone else going once? Going twice? Okay, I'm gonna pause that question, and I'm going to ask the next question. Sorry. And this one just goes to the heart of the matter. So we posed this question during our RSF in March. We've had a little bit more distance traveled, so to speak, and may have a clearer view as to how this year is shaping up. But how is your organization's regional profit projections relative to where they were last year? Okay, so over a third, down more than 10%, about 40% actually, about 31%, down 1 to 5%, not bad. More than 1 out of 10 of you who's answered is indicating that you're up 1 to 5%, which is nice to see. But the bulk, kind of over 50%, at least 5% down. Okay, I'm gonna pause that question, and then I will ask one additional question before we go into Simon's presentation. So this question is, how effectively do you think your organization is balancing short-term actions required as a result of the pandemic, conserving cash, for example, making sure employees are safe, with also looking beyond the pandemic? So how are you investing and aligning your activities in a way that supports your medium and long-term commercial interests and viability beyond the crisis? So over half of you are indicating that you think that balance you've got that balance right. As a matter of fact, I would say 8 out of 10 of you, more than that, almost 9 out of 10 of you are saying that you've got that balance right. Be interesting, perhaps through the questions and engagement, to get some further clarity on why those answers come through on either side of the spectrum, kind of strongly agreeing or disagreeing as the case may be. Okay, I'm going to turn that poll off, and I am going to invite Simon to take us a walk around the globe and share the latest Economist Intelligence outlook forecast. Simon, over to you.
Great, thanks, Herman, and thanks for joining everybody today. It's fantastic to be able to be with you virtually to share with you what we at the EIU see coming over the rest of 2020 into 2021 and beyond. Obviously, it's a critical time for the global economy. There is a lot going on, and our planning for 2021 has probably never been, for the year ahead, has probably never been more difficult. Let me start off by sharing with you three areas that I'm sort of bucketing my thoughts for 2021 that I'm finding useful for my own thinking about where the global economy is going. One is, of course, the evolution of the COVID-19 crisis. Second, other key global trends that we need to continue to pay attention to. And thirdly, what kind of long-term change might be coming out of this? What is transient change and what is more long-term change? I think where we are now is pretty much at the bottom for the global economy. Things are largely going to be on the up from this point. Will differ country by country. Some countries have already started recovering, some not yet, but at the global average, I think we are now at the low point. The recovery in the second half of this year, though, it is going to be modest, and then it's going to be quite a long slog after that to get back to where we were. So I think we are settling in for a couple of years of a fairly tepid global economy, a long time to get back to where we were, and we'll have to be prepared to be in this for the long haul, and probably with distancing measures coming and going, certainly over the next 12 to 18 months. It's not till the end of 2021 is our working hypothesis about when a COVID-19 vaccine will be in widespread use. So firstly, where are things going with COVID-19? We're going to dive into a lot of these in more detail later on. Herman stole my thunder already by mentioning that only one economy out of the G20 stands a chance of growth this year. That economy is China. Everywhere else is going to be in recession. We know that the recession is already happening, and we've already seen a lot of terrible growth numbers. South Africa, a couple of weeks back, released its Q2 GDP, minus 16% Q on Q from Q1 to Q2, one of the steepest falls in the world. Not the biggest. India and some other places have fallen by more, but South Africa certainly up there as one of the more affected countries. The second round effects from those growth impacts are starting to rise to the top of the agenda. Two, I think, are really important. One is employment. This matters a lot, of course, for living standards, for household incomes, flow and implications for firm demand, and then also in the longer term for skills retention and development, particularly amongst younger workers or people entering the workforce for the first time, where we know that the rate of skill acquisition in the early years of your labor force participation has very long-term impacts on your productivity. If people are unemployed for an extended period at the start of their careers, that affects them and then the country and the economy that they participate in for many decades to come. The second key area to focus on is debt. Unprecedented levels of debt being issued. The average debt to GDP ratio in the OECD is going to be north of 160% by the end of 2021. So very large increases. And even in the emerging world, we are seeing a lot of countries with unprecedented fiscal deficits as well. That is going to have long-term impacts. I'm going to finish off today by giving a view on where we at the EIU think that debt dynamic is going to play out. If we can, let's try and grab a little bit of optimism or try and think of a few opportunities, given that we are now probably at the bottom for the global economy. So much demand has been destroyed, so much market share has been lost, and scale has shrunk. As demand recovers, there will be the opportunity for a shake-up in many markets. Of course, we've had the big offline to online push, which was already happening, being accelerated by COVID-19. Those firms that were already engaged in a digital and or online strategy, or that were able to quickly pivot, similar to firms that were able to implement automation quickly to reduce their labor intensity. They have benefited well through this crisis. I think there will be further opportunities as economies around the world recover, to be more effective in the recovery, to have a strategy that is more agile, that is more attuned to some of these global economic and political trends that could give you the opportunity to steal a march on some of your competitors. Second set of issues, what should we be thinking about that's not COVID? There is still a lot, and even without COVID-19, 2020 is a very big global economic and political year. Firstly, we've got the US-China trade war. It's accelerated through COVID. It is getting worse. And we used to talk last year about bifurcation between the US and China being a risk. It's now a reality. Not for every sector, but for many sectors. Technology standing out. There is pressure on both sides, both from the US and from China, to get their tech supply chains and their tech ecosystems separated from each other. Other countries are finding, and other firms are, and firms from all around the world are finding, they are unable to escape that pressure, even if they want to do so. It's not universal. There are some sectors like finance where the US and China are deepening their integration, but that is very much the exception at this point. We're still talking about Brexit. It's been going on for a long time. We have what looks like the final deadline at the end of 2020. And what we know for sure now is there is no way there is time for a deep and smooth deal between the UK and the rest of the EU. We're left with two options, either a no deal exit, which would be quite disruptive, or at best, a bare bones deal that just minimizes the immediate disruption, probably sacrificing services to maintain free flow of goods. That's the best we can hope for at this point. I think that if you've got operations in either the UK or Europe that are servicing the other, I certainly hope your contingency plans are very well advanced. The US presidential election, the second biggest event of 2020 after the COVID-19 pandemic. Usually, crises such as this help incumbents. Think about George Bush after September 11, 2001. However, it looks like Trump is doing such a bad job at managing this pandemic that even in a year of crisis where people usually would rally around the incumbent, that he is set to lose this election. Our in-house political model of the US election gives Trump only a 20% chance of winning. So that puts Joe Biden firmly in the driving seat. Of course, 20% chance of winning, that's a slightly better odds than rolling a dice and getting a 6. So it's not off the cards that Trump could still win, but you'd rather be standing in Joe Biden's shoes right now. And finally, do continue to bear in mind the long-term challenges and transitions happening in China's domestic economy. It is so big now, the biggest trading partner for so many countries, including South Africa and many others around the African continent. I'll show you a map of some of those later on, that we've got to think about its own domestic transitions in terms of how they impact our business globally. It's got very high levels of debt. It has an aging population, very rapidly aging. The trade conflict with the US taking away a source of growth, and a real productivity challenge in its state-owned enterprises, bumping up against its ambitions to be a tech superpower. What kind of change might come out of this crisis? Some will be temporary, some will be permanent. 4 areas I'm especially thinking about. One is the rollback of civil liberties, which was already a trend pre-COVID. We had seen a reduction in things like the freedom of the press globally. We'd seen a reduction in the level and quality of democracy globally. This has accelerated through COVID-19. But for business, I think there is a risk or a contradiction coming down the line. During the pandemic, people don't mind in general giving up their personal information, their locations, their health data to governments for monitoring. As the pandemic recedes over the next few years, that is likely to change. And I think there's a risk that firms are going to get stuck in the middle of that. They'll be caught between governments and regulators who want them to continue to collect and share data on their customers, and that will ride up against customers reducing willingness in many places to continue to share that data as the memory of the pandemic recedes. The big state is back. I already mentioned the huge levels of debt that have been issued. There is going to be a payback for this. Governments have supported firms very substantially. There have been a lot of wage subsidies. There have been debt write-offs. There have been rent holidays. There have been tax holidays or even tax rebates. A lot of cash has gone from central banks, from fiscal reserves, taxes, into supporting the corporate sector. And in the aftermath of this, I think both politicians and also the public are going to have an attitude that they need some kind of payback from companies, and they probably won't be too discriminating about who got what during the pandemic, but it will be a more general trend. What kind of things might this mean in practice? I think tougher competition policy is probably on the cards, a bit more of a focus on national champions and a tougher environment for FDI. And I think there will also be a bigger focus on employment, particularly around training and apprenticeships, but also employment levels. Firms being expected to contribute to the economic recovery by keeping more people on the books. And I do think there will be selective tax increases as well. It'll be very hard to increase sales taxes or income taxes, but the corporate sector will be more ripe for attention. Nationalism has been reinforced all around the world, and then also our way of living has also been transformed, and some of these effects are going to be transient and others are going to be more permanent. So I've written urban exodus. It's a little bit of a straw man in a way. I don't think urban areas are disappearing. However, the ways in which we interact through these highly agglomerated cities are certainly going to be altered after this pandemic. We can think about the air being taken out of the bubble of the economies of some of these very big globalized cities like New York or San Francisco or Dubai. We have remote working, changing the relationship between cities and people and between employees and employers, I think in a longer term way. Big implications for residential and commercial real estate markets, and of course, new ways of doing business having a large impact on the travel sector. At this stage of 2020, I normally would be focusing really only on next year, but 2020 is so volatile, there's so much happening. I think it is worth touching on what is going on this year. Here are our growth forecasts for 2020 at the EIU, minus 5.2% overall. There's only one patch of green on this map, and that is China. It's the only major economic region growing, but let's not get too excited. It's only growing by 1.7%, not the 6 or 7% that China has been used to. It is just eking out a little bit of positive growth. Around the rest of the world, the worst hit regions are shrinking by more than 8%. Latin America, the Eurozone, and India, all areas with pre-existing weaknesses that have also been some of the worst hit by the COVID-19 pandemic. The next worst hit are the oil exporting economies in Middle East, North Africa and Russia. The double whammy, the pandemic, plus the big drop in the oil price. They're shrinking by about 6%. At the global average, round about 5%, we have the US, we have Sub-Saharan Africa, and we have Japan. And this will be the first time in a while that Sub-Saharan Africa has not done better than the global average, given the amount of catch-up growth that should be possible for the region to attain. Performing a little bit better, Australia, New Zealand at minus 4%, a little bit over. Southeast Asia, where I'm sitting, only shrinking by 2.2%. Some economies actually still growing, like Vietnam, like Myanmar. Others are doing as bad as the Eurozone, places like Thailand, Malaysia, and Singapore. Not on this map, but worth mentioning is South Korea, the best performing OECD economy this year, shrinking still, but only by 1.8%. So what a year when minus 1.8 is one of the world's best growth performances. One trend that is going into reverse that I think is quite notable is this trend of the emerging market convergence. We've had for many decades a situation where the emerging world has been catching up to developed countries year by year with higher rates of growth. That is going into reverse this year. Next year, the OECD is going to grow faster than the emerging markets once we strip out China. This chart shows in yellow our growth forecast for the OECD, in blue, in dark blue for China, in light blue for the rest of the emerging world. You'll see that yellow line above the light blue line this year, next year, and then only slightly above it after that. It's going to be a very tough couple of years for emerging markets outside of China, hampered by higher borrowing costs, weaker health systems, and weaker macro environments, less scope to reduce interest rates, more currency pressure, and more difficult to fund fiscal deficits. If we did this per capita, of course, that gap would be even larger given the higher population growth in the emerging world. And that's a recipe for lower living standards in many of these countries, including right across Africa. GDP per capita is going to take a big step backwards. What's going to happen in 2021? This chart shows what our growth forecasts are. We have the surprising headline of Europe being the fastest growing economy, fastest growing region in 2021. It's a bit of a cheat headline because the reason it's got the fastest growth rate next year is not because it's got a spectacularly robust economic outlook, but because the depth of the crash this year was so deep that it's just got more space to rebound out of that recovery. So you can see colored in orange, which means that the orange and red colors are economies that are growing faster next year. We have France and the UK expected to record growth rates of 6% plus, which they haven't achieved since the 1970s. Now that though is off the back of close to 10% declines this year. So places like France or Spain or the UK will record what look like nice growth numbers next year, but it's not going to be a sign of underlying health in their economies. And it does highlight right now, you've really got to be careful when you see economic data, when you see headlines, to look behind the headline and see what it was. There was actually a great example from South Africa that I've been talking about when I've been chatting to your ECN colleagues in other cities around Asia and the Middle East, which is around the GDP data that I already mentioned. South Africa reports that on an annualized basis, so as if Q2 happened 4 times in a row, which gave a number of minus 52%. And then we saw various headlines. South Africa's economy shrinks by 50%. I'm not sure if you had those domestically as well as the ones we saw in the international press. But of course, that was an incorrect headline. If Q2 happened 4 times in a row, yes, South Africa's economy would halve in size. But, well, fingers crossed, Q2 was not normal for the world and not normal for South Africa. So it was actually a 16% decline in Q2. So very important to look behind those headlines to make sure that you're interpreting the data correctly and getting the right insights for your business. And of course, we're here to help you with that over the next couple of years. Apart from Europe having fast growth rates, the stronger economies in the world next year are going to mostly be in APAC, which is something that we're more used to seeing. Even though China, Vietnam, Myanmar are all going to still grow this year, you'll see all of those economies still in yellow and orange for next year, still some of the fastest growing, even though they've also been some of the best performing this year. So that is not just a bounce back story. There is still a large part of that which is about fundamentals, for example, in Vietnam, about urbanization and about its integration into global supply chains. In fact, the Chinese economy is rebounding fast, in fact, too fast, and there's now an overcapacity risk. The industrial sector is taking off so quickly, but while domestic and demand remains weak, all that manufacturing inventory is now being pushed internationally into export markets, reducing the prices of China's manufactured exports. As demand is weak everywhere, that is bad news for people who are competing with Chinese manufacturers. Of course, it's good news if you're buying those manufacturers, but that overcapacity risk from China's industrial sector, I think will weigh on a lot of manufacturing sectors in other places over the next 6 to 12 months. Moving further around, you can see Africa, a lot of dark blue there. So still very slow recoveries, even though Africa's had a recession as bad as anywhere else this year. It's growing slower than the global average next year. So falling behind rather than catching up. Angola, we expect to be still in recession next year. Ghana, just eking out positive growth, only 0.4% in 2021. The bright spots, if we can find any, Uganda, Tanzania, Ethiopia, they were already fairly fast growers, of course, especially Ethiopia coming from a very, very low base. But it's going to be a weak recovery in sub-Saharan Africa for next year. While Europe is going to have a nice GDP growth number next year, overall, the recovery in the US and China is going to be better than that in Europe. Here's a snake chart of when we think each G20 economy is going to get back to where it was. Herman showed this in table form before. So China is first. China gets back to where it was in Q4 2019 this year over the next couple of months. Followed next year by Indonesia, South Korea, but it's not till late 2022, the second half of 2022, 24 months from now, when the US gets back to where it was, then Germany, France, and you can see all the other economies lined up there. And a lot of the big emerging markets down at the tail end of this. they are expected to have generally a slower recovery. Mexico, the last of the G20 in 2025, and then you'll see South Africa, third last out of the G20 to get back to where it was. What kind of things are going to affect whether the speed at which economies get back to where they were? One, the amount of fiscal space and commitment they've got. Do they have the ability to borrow? Do the governments have the ability to borrow more? Are markets willing to fund it at a cheap rate? Are they willing and able to spend it and spend it effectively? Similarly, on monetary policy, do central banks have space to cut rates? Do they control their own currencies and interest rates? What's the sectoral composition of the economy? Generally, in industry, I think will do better than services. There are going to be some exceptions, such as a lot of online and tech services. But overall, with us thinking that lockdowns and other restrictions are going to be on and off over the next 18 months as we await a full rollout of the vaccine. I know you all had a discussion about a couple of weeks back. Those firms that are able to be agile and most able to withstand these big swings in demand are going to be better placed. And it's easier typically for industrial and manufacturing firms to build up inventory and then reduce it when demand comes back than it is for the service sector. Let's talk through some of the major economies. The US are shrinking by a little bit over 5% this year. Trump is prioritizing ending the shutdown rather than minimizing deaths. US has the biggest outbreak at the moment. India is catching up and I think will overtake the US soon enough, but right now the US still has the biggest outbreak. That's having an impact on Trump's re-election chances. The economy is now not good news for Trump, and of course the pandemic is not good news for Trump. So he's doing his best not to talk about it. Instead, he's been pursuing a focus on law and order, trying to build up perceptions of a crime wave in the US, which is a well-worn tactic for right-of-centre political parties in the OECD. And of course, the recent death of Ruth Bader Ginsburg, the Supreme Court Justice, has kind of assisted him in that sense because it's brought more attention on those judicial issues and away from the economy and away from COVID. Huge spending going on in the US economy, $3 trillion of stimulus so far. We did think another $2 trillion likely, probably now more likely $1 trillion given the bickering on Capitol Hill, but Trump would like a bit more, even though many other Republicans don't. So we might see something like $4 to $5 trillion in total of fiscal stimulus coming out of the US, taking the fiscal deficit up to a huge 16% of GDP, much bigger than in the 08-09 recession. The stock markets there and in other places are really defying economic logic. Big divergence between earnings that are down by about a third and valuations that are on average above where they were pre-COVID-19. A lot of that is about liquidity from central banks, a bit of it from governments, a bit of sentiment. These lower interest rates, meaning an uprating on the valuations of dividend-paying stocks. There's a lot of sentiment in there as well, notably around the tech firms where people are kind of searching out whatever kind of optimism they can find. So there are some reasons, such as lower interest rates, why higher stock prices are valued because we can't get a return anywhere else. But a rally that's driven by sentiment and by liquidity is, of course, very vulnerable to corrections. One of the key risks in the US economy this year. China is not going to save the world this time like it did after the 08-09 recession. After then, China spent big, sucked in a lot of imports, and as you will know from South Africa, a lot of commodity prices went through the roof in 2010, 2011, as that Chinese spending went into infrastructure and sucked in imports. That is not going to happen this time. Fiscal deficit is going to be up by 700 billion. Compare that to 4 or 5 trillion in the US, 5% of GDP as opposed to around about 15. Only about half as much as they spent in 08-09. So China is very much focusing on its domestic economy now. So while domestically it's back to normal with the international demand remaining weak and also domestic consumer demand remaining weak as well, this overcapacity issue is emerging as a key risk. China's facing more political challenges internationally. International trust has really nosedived as China's really hardened its diplomatic approach, gone on the attack on governments and companies that go against its policies, even if they're not doing so directly in China, and companies that have got nothing to do with it also being brought in if relations between their home government and China deteriorate as well. This is backfiring somewhat on China. We have a lot of big economies and sort of medium or larger diplomatic powers like India, Canada, the EU, Australia, that were trying to straddle that fence. Security relationship with the US, economic relationship with China. We don't have to choose was the mantra. Well, they're now finding they do have to choose. And in fact, it's China who's kind of pushing them into it. The earlier China pushes people into choosing, the more likely they are to choose the US, because the US starts this in a stronger diplomatic position with a stronger diplomatic history, even though China is, of course, clearly by a long way the rising economic power. Here's a map that I mentioned before of China's trade dominance. Countries in red, that's where China is the largest export market. So we can see right across Asia Pacific, Central Asia, Middle East, Africa, Latin America. And if Europe was taken as a whole, Europe would also have China as the #1 trading partner. So big economic opportunities being picked up by more and more countries. However, that concentration does carry risks. Firms in places like Canada, in South Korea, in Australia have found that they've then suffered a lot in return and been quite vulnerable targets because of that over-reliance when diplomatic relations between their host governments and China deteriorate. Geopolitically, while China is having more challenges, it's also more powerful because the US standing has been severely undermined, its lack of global leadership and out of control pandemic, in contrast to China in this COVID-19 situation. So China is stronger, but facing more challenges. That mismatch is going to lead us to a decade of heightened geopolitical tension. Also, there'll be some other regions, particularly where economic and political power are out of balance, where we have places, say, like Russia, politically powerful, economically weak, bumping up against regions like the EU, where it's by and large the other way around. So the US-China decoupling and China's increasing international assertiveness, that is going to be the geopolitical theme of the 2020s. The road to recovery in Africa, it's going to be pretty tentative. A lot of governments have actually been proactive and tried to do as much as we could understand at the time, and it'll be a while before we know what really worked and what didn't, but have tried to adopt a lot of best practices from other places. But Africa has really failed to halt the pandemic. But luckily, because of its younger population, death rates are not as high as elsewhere, but still a huge economic impact. And fiscal inadequacy is hampering the recovery across the continent. In an African context, South Africa is a bit of an exception to that. It's got more ability to borrow than a lot of other African countries. We're already seeing debt restructuring in Angola and likely to see one coming imminently in Zambia as well. And there will be more of that to come. Here, the dots, the red is the growth forecast for this year, blue for next year. So you'd really expect the lower the red dot, the higher the blue dot, because that's where growth next year can benefit from a rebound from the depth of this year's recession. But you'll see that the red dots are a long way below zero if we compare that to how high up the blue dots are above zero, showing that most countries are not going to be anywhere near getting back to where they were for a number of years. And so for South Africa, if you remember, we thought it was going to be mid-2024 when South Africa would get back. There will be some debt relief coming for smaller and poorer economies where the debt's held externally, not much of a risk to international financial stability, and donors will largely be ready to write that off. The problem comes now that China is such a big creditor, where China prefers to do things bilaterally to try and extract some kind of favors or extract something out of the country it's giving debt relief to. That contrasts to the more open and multilateral approach that Europe and the US and Japan have tended to take in the past as the biggest creditors, but now the geopolitics plays in. The US and Europe are not going to give debt relief unless China does, and this is making getting some of those restructuring deals a bit more difficult to find. Energy and metal prices are declining this year. Few exceptions, gold at record levels. Most hard commodities, though, the average industrial commodities down by 7% this year. Agriculture, on the other hand, that's remained a bit more stable. That's been a bit of a support to the African economy as well. With low growth and people spending as much as government spending what they can now, a long period of austerity is coming. And we're starting to wonder, could that bring some long needed reforms in places like Angola or Kenya? Supply chains are slowly changing. You'll see a lot of talk from policymakers and a lot of being written in the international media about all the changes happening in supply chains. Australia, India, and Japan inked a diplomatic agreement last week to try and integrate supply chains more closely. That's really about telling Japan, telling its firms, get out of China and put stuff in India. Governments might want that to happen, but of course it's firms who decide where supply chains are based on their investment decisions. They will react to regulations, but it's ultimately a commercial decision. And FDI, by the way, in China this year is still rising, despite all of these problems from COVID and from politics. Foreign firms are continuing to invest more in China because the economics is there. So supply chains are going to shift. However, it's going to be limited and it's going to be constrained by or directed by the economic imperatives rather than just the political ones. Although governments may make changes, for example, to make FDI more difficult for Chinese firms to invest domestically. That's happened in a lot of economies around the world. So you'll see some of the incentives changing, but ultimately it's corporate decisions. And those of you involved in supply chains will know they're often highly integrated. There's a lot of benefits from specialization and from economies of scale, so that's not going to unwind. What will happen at the margin, just there'll be a little bit more weight put on resilience, a little bit less weight put on efficiency. We'll see more instances of multiple suppliers, even at the expense of lower average unit costs. We'll see higher inventory being held along the value chain, and we will see preference for connections in supply chains with countries that are closer to home, where that doesn't just mean kilometers, it also means closer in terms of political relationships and economic and social systems. I'm going to skip over the oil price for South Africa and talk a little bit more about, show you a bit more about commodities. Soft commodities are holding up better than industrial commodities and better than energy commodities this year. This chart shows in dark blue our industrial raw materials forecast, so a lot of the hard commodities, including the metals that are important for South Africa. White is oil, and then light blue is commodities overall. So this year, hard commodity prices on average set to fall by a bit over 6%. We think they'll recover a little bit next year, or by 5%, so still below where they were. And with that long-term drag really coming about because of the decline in the construction sector everywhere. It's labor intensive, it's hard to social distance on a construction site, and also it's something that can be delayed. Soft commodities have held up better. Consumers have been upgrading food expenditure. Prices have gone up this year. We think that will continue. Currencies mostly weaker. There's the Rand in light blue of the 8 I've put up here, the second biggest appreciation as a result of COVID, along with some other big emerging markets like Turkey and Brazil. We do see this as being a step change in valuation. We don't see an immediate bounce back in the currencies for those markets. We see more long-term economic challenges, and so therefore the devaluation persisting longer term. And that's, say, in contrast to a place like Indonesia or South Korea, where their currencies did drop in Q1, but have since rebounded, not all the way to where they were, but most of the way. We're now seeing a period of US dollar weakness as we get up to the election and the uncertainty around that, and also as the US has this large outbreak. I think next year that will start to abate. The US dollar will probably start to weaken, to strengthen a bit through 2021. Let's finish off just talking about debt. really high levels of debt coming out. Where does this go? What do you do with it? No surprise to hear an economist say there's no free money. So how do you get rid of it? You can either have austerity, and really good luck to anybody now, any government that is trying to cut spending in the middle of a pandemic. In fact, the opposite is happening, or to finance it through higher income or sales taxes. Maybe there could be some corporate tax increases, but not enough to reduce the debt levels. So that's not really an option. Second option is default. I talked already about why that's a feasible option for a lot of emerging markets. But for the big OECD economies, it's not really an option. Most of their debt is held domestically, and it's too big a share. It's a much higher share of GDP. It would be it would kill financial stability if a large OECD economy were to default. So that leaves you with the strategy of wait and hope, which doesn't sound that convincing, but it is what we think is likely to happen. What's the hope? You hope that nominal growth can get above interest rates over time. That will slowly reduce your debt burden. At the moment, I do think that seems likely to happen. Actually, at the EIU, we're doing some deeper investigations right now to firm up our long-term view on this, because we think it's going to be a trend that will shape the global economy for the next decades, not just the next 1 or 2 years. We really need a Goldilocks level of inflation here. Enough inflation to inflate that debt away, but not so much that central banks respond by raising rates and then making debt repayments unsustainable. So the house of cards can stay up as long as inflation doesn't blow it over. I think that's likely to work. I don't see a big risk of high inflation, but we should certainly keep our eyes on it. So Japan ends up looking less like an oddity and more like the norm. Japan's had this situation of high debt, low growth, low inflation for 30 years, and it shows no sign of coming out of it. So this is not a case of we'll issue this debt and then we'll kind of get back to normal in 3-4 years' time, which is by and large what happened after the 08-09 financial crisis. We're going to be in this probably for decades. So for sure, I think in future meetings, we'll be coming back to that in some more detail. I'll finish up there. Thanks very much for listening, and hopefully have time to take a couple of questions.
Excellent, Simon. Thanks so much for that presentation. And some questions have come through. I'd like to start with one that was posed anonymously.
Yep.
And the question is, with linkages in the global economy as strong as they are, notwithstanding decoupling and people looking to reshore and so on, what informs China's economic growth, especially considering that most of their regional partners are seeing their economies contract?
President Xi Jinping has just announced a new kind of piece of propaganda. It's called the dual circulation model. So this is kind of the latest iteration of what China's using to call its economic program. So we had the kind of Chinese dream over the last couple of years, which was more about nationalism than about the economy. And it was through that Chinese dream period, kind of, I guess, 2016 up till last year, where China's international situation got more complex, and also their foot went off the pedal in terms of economic reform, because prior to that it was all about opening up the capital account, which never happened, and about moving from investment-led economy to consumption-led economy. So that last idea, investment to consumption, that's now back, but it's reframed because the geopolitics as dual circulation. What are the two circles? One is the domestic and one is the international. The focus in China is more and more on the domestic. So their strategy with all of their international tensions is try to avoid outright conflict. So you'll see, like, they were very bombastic in kind of and feeling very gleeful about COVID-19 and how they dealt with it in March and April, and using that opportunity to go and try and like bash other countries like like Australia or like the EU, which then sort of backfired on them. They've now withdrawn, and they're not reacting too strongly to Trump's ongoing provocations. Their strategy is try not to have an outright conflict, but get ready for a decoupled world, right? So get ready for resilience, try and diversify your supply chains, especially in things like semiconductors, where they're still very reliant on the US before the politics reaches crunch point. So China's now focusing on the domestic economy. Its risk there is that as the Communist Party and the state-owned enterprises have more power under Xi Jinping, they're a lot less productive, right? So you get a lot less return for your capital in an SOE, so that's going to drag the economy what is the thing that could make this dual circulation model work? It's tech. That is China's big bet. And they have got a few runs on the board. And Huawei is a great example. Like, they are a genuine innovator. Now they're facing a lot of commercial challenges right now. But China does have genuine tech innovation, as well as a lot of sort of tech copying. But the share that's actually innovation is much higher than it used to be. And they are genuine world leaders in more and more areas of the tech sphere. That's their bet, that they can get enough productivity growth from tech to compensate for the keeping of control of the rest of the economy, and then focus on the domestic rather than international.
Great, thanks for that, Simon. One of the things you mentioned during your presentation is that one of the larger OECD countries is unlikely to default on its debt, notwithstanding the eye-watering kind of increases in debt to GDP levels. I'd like to not necessarily challenge you, but come back to that point, because what COVID-19 has certainly done is expose existing weaknesses. You know, South Africa, where I'm sitting, was in recession before COVID-19 hit, right? Italy, going to Europe, it's a large economy in the European context, third largest sovereign debt market in the world. And it wasn't doing too well before COVID really started to bite.
Yeah.
Is there a risk that a country like Italy could default, for example?
I mean, of course, there is a risk, but I think it's very unlikely. I mean, in Italy's case, it effectively has the rest of the EU standing behind it, and sort of the German fiscal firepower and borrowing capacity as well. What you will see in those economies, and where the government has a huge amount of debt, the central bank effectively will just have to keep interest rates at zero, right, in order to stop the repayments on that debt becoming unbearable. If you've got loads of debt, but interest rates are zero, fine, it doesn't matter, right? Like, your repayments are zero. And that's basically what Japan has done. So it's not inconsequential, right? You don't get away with it for nothing. The consequence is you have to keep interest rates at zero, which then raises the risk of financial bubbles. And then it also increases the risk of zombification, where firms that really should go bankrupt never do, because those loans never get called back in. And we've seen in a place like Italy, over the long run, that reduces your productivity growth and then reduces living standards. So you don't default, but your living standards go down. And so I think that's a more likely path for Italy to continue on, and then for more countries to join, rather than outright default.
Zombification, and we're all Japanese potentially. I think we can fit in two last questions. One comes from Henko Deploy, who's asking for your opinion on the potential of terrorism growing globally. And then Mbali asks, and this gets to kind of a sectoral focus, how do you think the travel industry is going to fare in 2021?
Okay. I actually had a look at some global opinion poll survey data this morning by chance, and it shows that the level of concern around terrorism has dropped markedly. So I guess unsurprisingly in a way, because COVID is much more of a concern, but actually concern about terrorism has dropped a lot more than concern about other issues, say like climate change, where concern has dropped, but not by as much as terrorism. So I think generally people and governments are less worried about that than they were. Are they right to be less worried? I think overall, yes, the threat is lower than it was, but has not gone away. Why is the threat lower than it was? Mostly because the oil price is lower, right? And that's where the funding for a lot of terrorist activities comes from. On the other hand, there is still an ongoing conflict between Saudi and Iran, which means all the little proxy conflicts all around the Middle East, places like Lebanon, like Yemen, like Libya, they're all going to continue to kind of bubble along and probably intensify in some ways. And they are perfect kind of breeding grounds for terrorist activity, because they're kind of beyond the reach of the law, and people are and the combatants there are looking for ways to kind of raise finances. So I think terrorism should still be on the agenda, but the risk I do think is lower than it was. For travel, main thing I'd say is that to join the ECN event we're running in a couple of weeks on tourism and travel, where we have some fantastic speakers like the CEO of Schiphol Airport and senior executives from Emirates, from Japan Airlines, who are going to be discussing this issue, so that they will have much more insight on that. But my thoughts are that business travel will be very slow to rebound, that leisure travel will come back first. I think firms are enjoying the impact on their bottom line from not having to have as much travel expenditure. We're also, as businesses, we're learning we can actually do a lot more online than we thought we could, right? Like all those things we used to say, oh, I need to go there to do this presentation in person. There's going to be, I think, a bit of a higher hurdle to really justifying that to your CFO in future. And also on the that's sort of like the supply side of travel, so the demand side, the supply side, us as individual business people, I think we're going to want to travel less because travel is going to be a hassle. It's going to be a real hassle. You're going to have to do COVID tests. You're going to have to do quarantine. You're going to have to do itineraries. I don't mind doing that maybe to go home for 2 weeks at Christmas, but I'm not going to do that to go and speak at a conference, right? Or to go to some business meeting. So I think both employees and firms are going to be less into business travel for various reasons. So I think that will be very slow to come back and probably will never come back to where it was. Leisure travel will be, I think, fewer trips, but for longer.
Great. Thanks. I think I'll try to squeeze in one more question, which comes from Pippa. I think you touched on this to an extent, but she's asking, what are the key factors driving Africa's slow recovery? You mentioned issues of commodity prices, high debt levels, and not necessarily having the benefit, so to speak, of denominating that debt in local currencies, but in hard currencies, and that will crowd out investments in other areas. There's also that silent kind of overlooked area of remittances, which are taking a hit from folks working in Europe or elsewhere. But I don't know if you have any other thoughts that you may want to add on what's kind of embedding the slothliness of the recovery in the African context.
I mean, the biggest thing, I guess, as always, is South Africa and Nigeria, right? So the two largest economies that have kind of have had very poor policy making for a long time, as I know that you've been discussing in your network. And so when you've had economies with pre-existing weaknesses, when COVID-19 has come along, they haven't had the ability to respond because they're already suffering. As you mentioned, South Africa was already in recession, right? So it didn't really have a lot of, it didn't have as much spare cash as it would have had to throw at a response, or the ability to raise as much money on markets as it otherwise could have if the economy had been in better shape. In some ways, the savior for Africa is going to be the agriculture sector. So to the extent that economies are less urbanized, and are still where subsistence agriculture is either a lifestyle for people already, or like the sort of economic mode of operation for people already, or a backstop, right? So we might see a bit of deurbanization, so people leaving some of the big urban agglomerations, going back to hometowns or home villages where agriculture remains a backstop, and soft commodity prices should continue to rise. That will be a bit of a backstop for the economy, but the low oil prices is going to hit North Africa, Angola, Gabon, and all of the kind of oil producers, and hard commodity exporters like South Africa suffering this year. Exception being gold, where gold producers are doing well, but then a lot of the gold producing countries are also in the middle of bouts of political instability, which is reducing investment as well.
Great. Simon, thanks so much for spending time with us today and sharing your perspective and insights. Certainly a lot to chew on there. I'm going to get more familiar with being Japanese myself, and we appreciate the time and certainly look forward to the next opportunity to engage you in an ECN forum for the ECN African members.
Great, thanks Herman, and thanks everybody.
Thank you. Okay, so we switch our focus at this point in the program from what's happening on the global scene and turn our attention very much to where we are in the South African context. And I'm very pleased to have two very well-positioned speakers, informed speakers, to contribute to this aspect of the program. Anne Bernstein, the Executive Director from the Center for Development and Enterprise, and Kaz Kuvadia, the CEO at Business Unity South Africa. As Simon indicated, I guess quoting me to a certain extent, South Africa came into this pandemic not on the best of footing. The economy contracting in the fourth quarter of 2019 and also in the first quarter of 2020. And we know, whether you look at the annualized number, which is very scary, or the quarter-on-quarter number, which is scary at 16%, we're in deep and turbulent economic and arguably social waters as well. And there's some key questions that I'm sure don't come as a surprise to anyone listening on this line. Can South Africa and the ruling ANC, as part of that mix, positively turn the economic and fiscal fortune around in the medium term? And if so, what actions are required by a range of stakeholders over the short, medium, and long term to correct the current trajectory of low to negative growth, as well as real possibility, a looming sovereign debt crisis? To engage on these and other issues, as I mentioned, will be Anne Bernstein and Kaz Kuvadia. And Kaz, I'd like to start with you, wearing your hat at BUSA. Just ask you to unmute yourself. I see you're on mute, and turn on your video if possible, to share kind of a perspective on the plan that was recently announced in the media, that apparently has been agreed at NEDLAC between key constituents, business and labor, and government. It still, as I understand it, has another step to go, at least one step, which is to be debated and perhaps approved as is or with amendments by cabinet. But if you can give us a sense of what's encapsulated in that plan, the timing associated with it, and how it may converge or diverge from what BUSA put forward.
Okay, can you hear me okay?
We can, yes.
Thank you, and thank you for the invitation. Let me just take a step back. So BUSA established a business platform called Business for South Africa to enable business to make certain interventions and work with government during the COVID crisis. And we developed a post-COVID economic strategy, economic recovery strategy. From a BUSA point of view, that's the economic recovery strategy we have put to government and shared with other social partners. And that's a comprehensive strategy that looks at short-term issues, that looks at medium to longer-term structural reform issues, and that looks at the fiscal problem that we are in. The so-called plan that we put together, which we presented to the president last week, Tuesday, and which all social partners have agreed to, is one part of this overall economic recovery strategy. And it actually itemizes, if you like, some short-term interventions that particularly government can make that would instill confidence both in potential investors and in the public, and will instill some confidence even in local investors who can then actually begin to release some capital and release some investment into the economies. And the unfortunate part about this is that there's very little new in these lists of interventions, because this is something certainly business has been talking to government about for the last 3 years or so. So what do we have in there? We say in there that we've had 4 tranches of renewables. The RFP has not been issued for the 5th tranche. Issue the RFP. The policy decision has been taken, the decision has been taken. Issue the RFP so that the financial sector can come to the party to actually bid for this. Okay. We've we've been talking for a couple of years about releasing spectrum so that we can actually increase our capacity. And it's become pretty evident during the COVID crisis when everybody's been working virtually. Again, decision has been taken, just implemented. Some of the critical interventions that need to be made at the Durban port to get efficiencies going, to look at, to reduce the pricing, the cost of actually trading goods there and so on. Again, decisions have been taken, just implemented. So it's those sorts of interventions that we have put to the president. And we've told the president that if government actually implements those, it immediately raises confidence and it immediately enables business to actually do what business is good at doing, investing and creating jobs. We've also got there sort out the issues around licensing of exploration, mining exploration. If we sort that out, the Minerals Council tells me that they will come in with significant investment in exploration. And we're talking about localization, because one of the, I think, impacts of COVID, both positive and I think in this case, a positive impact, is that it's sort of put high up on the agenda the possibilities of local manufacturing of some areas of the economy, of sectors. We've been reasonably successful in the latter part of COVID in actually developing local manufacturing of PPE, and we can, off the back of that, use some best practice to actually broaden that into other sectors, and we're talking about that. So what we presented to the president, and this has been agreed by all social partners, is a list of immediately implementable action items that actually instills confidence. We've agreed at NEDLAC that we will continue this process to lock horns on some of the structural reform issues and what we do about our fiscal situation. So I hope that clarified it. Let me stop there.
Thanks, Cass. Anne, I'd like you to come in. I know you've done a lot of thinking, a lot of writing with regard to the CDE's view on what needs to be addressed. What's your take on what Kaz said? What you're aware of the plan in general coming out of NEDLAC? Where do you think the boxes have been appropriately ticked, and where do you see glaring and important areas of deficiency?
Well, let me start by saying that on the one hand, I think business in South Africa has mobilized fantastically around COVID, and that Cass and his colleagues are deep in endless discussions to try and push the economy and the recovery program forward. I want to lift our eyes for a moment, and then I'm happy to come back to some specific questions. So I think part of the difficulty South Africa has is that many people in government and in the ANC and in the cabinet do not fully appreciate the seriousness of the situation that the country faces. And that until they do, they will stay in their kind of current positions of, let's call it, more of the same. And the problem is that South Africa will not come out of its growth and fiscal and unemployment crisis and this COVID exacerbation of all of that unless we have a radical shift in attitudes and in recognizing what has gone wrong. Why is South Africa in such a terrible situation before COVID, and then because of that, unable to respond to the economic consequences and employment and social welfare consequences of COVID much more effectively and with more firepower? So I think I considered, until we get some new thinking on, boy, we got a whole lot of things wrong, and we have to change attitudes and ideas, it's going to be very hard to get South Africa going again in terms of what we need. And the fact is that state capacity in this country is weak and corrupt. And you have to accept that reality, hard as it is. So I am in favor, and South Africa needs an effective, capable state. But we don't have one. And to build one is going to take years. And so the big question we have to all ask, and it's a very hard question, is what do we do tomorrow when the state cannot implement the reforms that we need? So thinking about mechanisms for implementation, all the things Cass has said, which are good things, I support them all, except localization, but we'll come back to that. I think business is there's some real problems there. But the real issue is who will implement tomorrow? Because look at what happened under COVID, the unbelievable corruption, just appalling state actions aided and abetted by other people outside the state show you what happens when state capacity is weak and corrupt. The fact is, this country does have capacity, but that capacity predominantly lies in the private sector. And the only way out of the crisis that we're in, the multiple crises that we're in, is to free up the private sector to perform at its maximum. Instead of notions of state disciplining capital and telling it what to do, we need to free up the private sector. And personally, I would be in favor of emergency provisions that allow firms to really survive and to get going and for new firms to be created. We've been talking about deregulation forever. It's time to just do it. So I think we need a different kind of mindset, which is we're in a terrible situation and we have to act differently. Kat mentioned one aspect of energy, which I support. You know, why is the fifth window for independent power producers not an urgent action? It's long overdue, but there are other actions that could help. The private sector has extra capacity to help South Africa's energy crisis, and from the mines to Sasol to the independent power producers from windows 1, 2, 3, and 4 who could quickly bring on additional capacity to our aging infrastructure. And it's important to bear in mind how important this issue is. Without energy, South Africa cannot get back to faster growth. It's as simple as that. And you would think that would then be the absolute top priority to make sure that we do everything we possibly can as quickly as we can to sort out the energy crisis. And just let me give you one example. The Eskom power cuts that we're currently experiencing will completely cancel out the positive impact created by interest rate cuts and the relief payments paid out under government measures to help workers since the COVID-19 outbreak. So these things are all interconnected, and until we sort out energy supply and look serious and acting effectively, this feeds into persistent kind of investor lack of confidence in South Africa. So I don't think South Africa is going to move forward unless government is seen as a credible reformer. And that means you've got to say what you're going to do, you have to then do it. You can't keep delaying it. Kat starts by saying there's nothing new. We're all sick of tired of talking about the same reforms that have to happen. And bold choices are needed now if we're going to move beyond the talk to actually get our economy growing and becoming much more labor intensive. And the fact is that if these bold choices undermine the ruling party's unity or its alliance, well, it's the national interest that has to prevail and not party politics. So I am opposed to this endless talk of compacting. I think compacting's fine, but it's not a replacement for leadership. You have to lead and then encourage people in the direction you want to take as a leader and provide a frame for compacting. Otherwise, you get lowest common denominator things. Business has to compromise. We kind of continually do what we've been doing for the last 12, 14 years. So I'm opposed to that. I think it is a real problem in South Africa. One of the big issues that we face is, of course, the fiscal crisis. And I think a lot of the recovery strategies mention it, but they don't deal with the consequences of this. South Africa's fiscal crisis is deep, and it's getting worse every day. The ratio of debt to GDP has doubled in the past 10 years, and debt has increased threefold. And the cost of servicing South Africa's debts are rising faster than any other item on government's budget, and are gobbling up a rapidly increasing share of all tax revenues. So we have to deal with the fiscal crisis. It's the fact that it exists dampens our chances of growth. On the other hand, we have to get growth going in order to deal with the fiscal crisis. And I think a lot more attention needs to be paid to that. The last big point, two big points I want to make. The first is that South Africa will not get growth if we continue with the wrong attitudes to business. If you read the ANC recovery strategy, they want to discipline business. They see COVID-19 as an opportunity for expanding the state, its incapacity and corruption notwithstanding. I think this is the wrong approach. A developmental state is not possible in South Africa today. And we have to free up business and change cabinet and government attitudes to business as not a problem, not something to be feared, but as we need a much more competitive market-driven approach to recovery. So all of this is compounded with a massive and growing unemployment crisis. Before COVID, in February this year, you could say we had 10.3 million unemployed people in this country. And if you were a young person, aged 15 to 24, you were 70% unemployed. There were 500,000 young people less who were employed in 2020 than in 2010. Just think about that for a moment. So we have to move towards a more labor-intensive economy, and that requires labor market reform. So the truth is, South Africa has a long list of things that have to be fixed. It's impossible to fix everything at once. I support business in talking about key priorities for action now. The key thing in my view is we have to stop tinkering. We have to stop tweaking. We have to stop pretending. We don't have to make hard choices, hard trade-offs, as our Reserve Bank governor keeps saying, if we're going to move forward. We have to stop pretending we have an effective state and that we can just sort of tweak at the edges to make things better. We must stop repeating bad old approaches. So we need reform. We need an enthusiastic reformer to lead the country. He needs a team of people to back him with technical and political expertise. On the one hand, how to use the levers of power. On the other, how to create a narrative of hope and momentum for the country. We need a game plan for reform that is political. How do you build a political coalition to back the reforms that have to be taken? And then we need some quick wins as quickly as possible to build momentum for a reform strategy. Let me end by saying that South Africa has all the potential to be a great African lion of an economy, but we keep disappointing. And until we have leaders with the vision and courage to make the bold choices that we desperately need, South Africa is going to keep being in trouble. I'll end there.
Thank you, Anne. I'm thinking of Representative Lewis when he spoke about us getting into good trouble, and those comments were particularly no punches pulled, hard hitting, but I would say delivered with love, and certainly complimentary to the business sector, Cass, where you're from, for the role that it's played in trying to move the country forward. And one of the points that Anne mentioned, I'd like to get your perspective on, perhaps too. Do you agree with her that there isn't a proper acceptance or realization of the crisis we're in? And if so, why is it that these things which you kind of listed, Cass, that we've been talking about for a while, spectrum and dealing with the energy crisis and so on and so forth, why is it that they haven't been dealt with decisively?
Yeah, so let me start by saying I have no arguments with what Anne is saying. I think that certainly as BUSA, we are concerned that there is still not a realization in the state of the crisis we are in and the serious situation we are in. I think the president acknowledges that we are in crisis, acknowledges that we have to move with urgency, but as a government, they are not moving with urgency. And I think that there are a couple of reasons for this. The one is, to an extent, I think we don't just have an economic problem, we have a political problem as well. And the political problem are the problems in the ruling party. And I think the president has consistently sort of concentrated on trying to unite different factions in the ruling party. Those factions have had an impact on his ability to govern. I think his cabinet is not on the same page and often ideologically on the different page. And I think that the sort of alliance with Labour and so on makes it extremely difficult, if not impossible, for government to actually rise above some of the friction between business and Labour and actually give some direction. So I think those are all valid problems and they're real problems. I think the other issue, and Anne has spoken about this, is the capacity and capability of the state. There's absolutely no doubt, and COVID has starkly sort of emphasized this, that there are serious capacity constraints in the state. And what we have consistently done as business, and publicly said so, is to say that we are prepared to assist the state with capability and capacity. But there needs to be a receptivity on the part of state to actually accept that.
Does that, sorry, Cass, does that plan that NEDLEC approved, does it put forward, is there agreement on where the private sector will come to the support of the state, where capacity is not up to scratch?
Well, I think for the first time in a long time, all social partners at NEDLEC have agreed, and in fact, Labour has been quite clear on this, that the capacity and capability of the state is weak. All social partners, and it's in the document given to the president, that one of the sort of immediate things business can do, because it can't invest in any big way until the environment is created for it to invest. But one of the immediate things business can do is provide capacity and capability. as we tried to do during COVID in the distribution of UIF and other stuff. So it's in the document. I mean, the president's response to the document was that he's going to take it through cabinet and so on, and then respond to us. So we haven't had a government response on the offer of capacity, and where if they say yes, then we can structure this thing properly and so on. But it's in the document and it's agreed by all social partners. So I think that those are the reasons, I think, why there hasn't been action. And we absolutely clear. And when we presented this document to the president, the BUSA president, Sipa Pitiana, said that it's now all about implementation, and decisiveness and leadership. And says we need a reformist leader. And I think the President Ramaphosa has the capability of doing that if he rises above the fray and leaves us as president of the country and understand that there are certain hard decisions to be taken in the national interest. Because this isn't rocket science, and it's no longer an ideological debate. If we don't get investment in, if we don't get growth going, and we're absolutely clear we've got to structure that growth so that the vast majority of people have some stake in the economy. It's got to be inclusive. If we don't get growth going, if we don't make it easier for businesses to operate and to be profitable, if we don't improve our competitive rankings, we haven't a hope in hell of addressing our fiscal situation, right? Because if we don't broaden the tax base, deepen the tax base, reduce government expenditure, these are all sort of basic stuff. It's not rocket science. But we need leadership and some decision making from the top that says this is what we've got to do in the national interest, and this is what we are going to do, and then manage. And so, you know, and I agree with Anne, compacting and so on is fine, but you can't get into consultative paralysis. Government needs to consult, and then it needs to take decisions. Even business might not be happy with all the decisions government takes, but there's at least a degree of certainty. We know the environment in which we're working, and we carry on working, okay? But if government puts itself in a position where it can only take decisions once it's there to reach consensus through consultation, then we in paralysis. And so we need that sort of decisiveness, we need that sort of leadership. And I think that there's a potential, if the president shows that sort of leadership, I think there's a potential for a broad spectrum of society coming out and supporting him in that.
So Kaz, one of the key events on the calendar is the medium-term budget policy statement. That's coming up next month sometime.
Yeah.
From my perspective, that would be an important marker to demonstrate that key decisions have been made, at least when it comes to allocating or reallocating capital.
Yeah.
So, we're not far away from that. So,
no.
Where to from here? So, the plan has been agreed by NEDLAC. It now needs to go through a cabinet process. When should we expect to have a firm decision about this is what we're doing, and we're acting with urgency, and we can tangibly see the fruits of that action, if you will, in things like the medium-term budget policy statement, in things like ICASA acting to release spectrum, and so on and so forth?
Yesterday, actually. I mean, and one of certainly my disappointments is that when we presented the plan, I think it would have been ideal and appropriate for the president to say, well, we've taken the decision that we need to have a 5th round of renewables. Minister of Energy, facilitate a process that you issue the RFP within the next month. That's what we need, right? ICASA, I want to see spectrum released within the next month. That's what we need to see. So you know, we would, and I can't answer definitively when we'll get a response from government on the implementation of their process. We would hope that, I mean, the NEDLAC process, we've been continuing to meet to see if as social partners, there's any area where we can get some implementation going. I mean, there's very little we can do without government actually pulling the levers. But we would hope that you know, in the run-up to the budget, that in the next week or two, the president comes back and makes some pronouncements on the plan. The Minister of Finance's position is publicly clear. He's publicly expressed his views on the matter. He's talked about a zero-based budget, which he will start at the medium-term announcement. He's absolutely clear on the priorities. He's absolutely clear on the crisis we are in. The issue is that the president now needs to come out publicly and support some of the positions the minister has been taking. So do I know exactly when we're going to get a response and whether government is going to be decisive on it? I don't. I'm hoping that within the next 2 weeks at the latest, we do get some sort of positive, decisive response from government.
Great, thanks, Cass. And I'd like to come to you, because you made the point very clearly in my rephrasing that the time for dilly-dallying has long passed. These issues need to be grabbed by the scruff of the neck, so to speak, and we need action now and strong leadership. But it in some ways it would be naive not to consider the politics. I'm not saying that you haven't, but what do you think is politically easy that can be pushed through with urgency, and probably more importantly, where are the particularly difficult issues which you know, they have the potential to go horribly wrong given the kind of power dynamics between the various constituencies, that you think the president in particular has to be careful as he treads that ground?
Look, I think one of the problems in South Africa is that people always want to talk about low-hanging fruit or what are the easy issues. Mm-hmm. We're long past that stage. There are very few issues that don't require bold choices. So that's my first point. The second point is you have to understand that corruption has got into the very essence of decision-making. So the state isn't just corrupt when it procures. We have weakened decision-making processes. We have vested interests in those decision-making processes, which you have in any society, in both business and government, but in South Africa, it's got very deep indeed. So why would nobody, I mean, it's so obvious that we need more energy and everybody wants it, but why are we not acting? Why is the minister not acting? And if he isn't acting, why isn't he fired? That's all about politics, patronage, all sorts of things I don't know enough about, but we can all imagine. So here's one example where you would think you could act easily. This is a low-hanging fruit. In February 2019, the president said, South Africa is doing worse and worse on the ease of doing business, i.e. we're more and more of a costly place in which to do business. We've moved down, we've moved up in the numbers, but we've got worse and worse, so we're now at 82nd in the world. I'll commit my government in 3 years to moving down 50 places. Great. What's the delay? In 2020, we didn't move down. We went from 82 to 84. We got worse. Why can't we immediately decide, and this would be something along the lines of an emergency provision I'm talking about. You say, business can give me 50 regulations that hold you back. Small business, big business, medium-sized business, informal business, we're going to just eliminate them with a presidential decree within a month. Why not? You know, maybe it's 2 months, but show willingness. So I think that would be one. But the truth is, as Kim said, it's all about politics. So you want to move forward on the ports? Well, it's complicated because it's run by a parastatal, and that means we've got the worst port charges in the world, and we're not very efficient, and so on and so forth, holds us back. In one area we're doing well, which is agriculture. We could be exporting more if we had better port capacity. So then you say, so what progress have you made in thinking about which state-owned companies should be retained and restructured because they have capacity and they're vital for the economy, and which should be closed down or sold off or whatever, privatized, the dreaded P word. What progress have we made? No, the Minister of Public Enterprises has spent 70, 80, 90% of his time on SAA. Why? We're experiencing the worst aviation crisis probably in a generation since the Second World War, I would imagine. No, South Africa is determined to have a state-owned airline when there are private airlines that could, and other airlines that could deal with South Africa's needs. And so not just time and effort of that department is going into that one issue out of all proportion in terms of its impact on the economy. Plus now, and I don't think we should underestimate the impact of this, now the government has gone against what the Minister of Finance has said since the day he became Minister of Finance, and they are going to fund SAA. Now this has ramifications, not just you have to find another 10.4 billion in a very tightly constrained budget, which means you have to cut other things. We've already cut something like 20% in the June-July budget. Now we're going to have to cut more for something that is a very hard priority to make, but it's going to have ramifications in terms of the government's court case on wages, which could result in another 68 billion over 2 to 3 years. And it sort of undermines the case for zero-based budgeting, which is not going to start happening in October. I'll eat my proverbial hat if it does, but I can't see that. So, you know, when people ask about short and long-term priorities or low-hanging fruit or easy and hard ones, the truth is, we have to make a decisive turn in direction. That's what's required. And then you choose, and that will be a political process. It should be more economically, but you then say, what are my 4 top priorities? Energy has to be one, without doubt. Dealing with employment has to be a second one. There again, we tweak on the edges. We won't take the major decisions. And then growth, we've got to go for growth, which means the proposals for how South Africa recovers are not one among many proposals floating around South Africa. I sometimes think that's our only growth industry, developing recovery strategies. But the business proposals, market-oriented proposals, aren't one among many. They are the most important proposals on the table. Because not just will you get results, but if you do what business is saying, investment will follow. Nobody else's proposals are talking about that. They just want state money. So you've got to think about, and that's where I'm opposed to the notion of NEDLAC and social partners as though they're all equal and so on. The realities of South Africa today is we have no choice but to make a decisive shift towards a market-led strategy. And that has a number of consequences. So I can give you a few more sort of priorities, but I don't think that the decisive shift is being talked about sufficiently, even in the NEDLAC document, which, sure, I find a very strange document, but we don't have time to go into. There's lots of compromise, there's lots of fudge, there's lots of not dealing with the absolutely core issues. So I think, we're at a point now that there aren't simple things. And anyway, this state can't implement easy things. Look at the job summit in 2018. No policy discussion, no reform discussion, but projects and interventions. Small things. These things weren't implemented. You would think getting our visa system right for both tourists and for skilled people, which we desperately need, you'd think we could have got that right, but we haven't. So that's why I'm saying you've got to make a bold change of direction. You have to recognize a very hard thing, which is that the state is corrupt and weak. Not everything, but you can't assume they can implement. And then you've got to wrestle with how you do it. So business is saying we can second people, which it's a gesture of goodwill and commitment to the country. Exactly how that will work is not clear to me, because who manages business? There are vested interests in business as well. So you've got to think very hard about interim mechanisms while you seriously start to build a state built much more on merit than on who you know and patronage. And that isn't a black-white thing. There are many Black South Africans of professional competence and commitment who can perform very senior roles in our economy. But that's not who we appoint to do things, generally.
Thanks, Anne. What I took out of part of what I took out, there are many takeaways, is that there's some hard choices and some trade-offs, therefore, that need to be made. And we have a question that's come in, and I'd like to get Cass's comment first, and you're welcome to comment on this afterwards. Joseph Mbuyi is asking, is the idea of strongly combining economic transformation goals, and I suspect implicit in that is layering in things like broad-based Black economic empowerment and so on. So is the idea of strongly combining that transformation-related goal with rebuilding of the economy really helpful or appropriate at this current time, given the scale of the challenge that we face? And Cass, before you answer, I just want to remind everyone on the line, we have another 7 minutes or so. If there are any burning questions that you have, please pop those into the chat box, and we'll try to get to as many of those as possible before our time is up. Cass, over to you.
Okay, so I think the problem from our point of view is that the way we've structured and implemented Black economic empowerment policies and the way we've implemented them has positioned transformation in a way that is contrary to economic growth. And I don't think that necessarily need be the case. I think that we can actually structure our economy in a way that does address transformation by doing the right thing. So if you, for instance, taking the hard decisions, including a regulatory environment for the growth and development and strengthening of small and medium enterprises in our country, it actually talks to transformation. If you actually deal with the energy situation, instead of protecting Eskom's monopoly, you actually deal with the energy situation that reduces the cost of energy, that reduces the cost of basic services that people have. If you become more efficient, you're dealing with transformation. So I don't think transformation is just Black economic empowerment. Transformation and an economy that also addresses transformation is an economy that actually begins to address the improvement in the conditions of living of the broad spectrum of people, and an economy that actually creates opportunities for people to participate in that economy. And that's the mindset we should have. And if we have that mindset, I think the two are complementary.
Thank you. Anne, any thoughts?
Yes, I want to support what Cass is saying. I think that We need a much deeper conversation, a much more rigorous conversation about transformation in South Africa. And it begins with transformation for whom? I am in favor of transforming the lives of millions and millions of South Africans who are unemployed, who are excluded from the economy, and who don't have opportunities in our society. That requires much faster growth and much more labor-intensive growth, and as Cassie said, cheaper energy, cheaper bandwidth, and so on, because that will expand how people with very little can get into our economy, and that we can create more and more jobs so that we're providing the kinds of jobs for the labor force South Africa actually has. We've gone through a high-skilled, higher wage approach to development, and it's failed. We have one of the highest unemployment rates in the world, whereas many other countries, almost every other developing country that doesn't have oil, has gone for a route of low skill and often lower wage jobs in factories, making your and my t-shirts and our shirts, and slowly going up the ladder where both firms become more sophisticated and workers become more skilled. But we deny that opportunity to learn on the job, if you like, to South African workers who are desperate for employment. So I think transformation is a much bigger term then, who gets the procurement contracts and this and that. We've gone for elite empowerment. I don't think that is transformation. So I think this is a conversation that needs a lot more rigor and depth. And it would be nice if we had more facts on the table. But employment is key to inclusion. We have to have more competition in our existing economy. So sector by sector, we have to look at the barriers that hold back new entrants. That's deregulation, and maybe the big guys have organized things to suit themselves, but you've got to prove that. And you've got to then open up that sector of the economy. We should do that much more systematically. We've got to fix education. It's appalling, it's criminal that so many South Africans can't read or write or understand for meaning. We spend in the upper echelons of what countries all over the world spend on basic education, but we have a very low performance system, and that holds people back. That holds back transformation individually for families and communities. We need a much better skills system as well. So I think the debate on transformation needs to be much more serious. It needs to include all those people that we tend to ignore, the half of our society that are poor, unemployed, and just kept out of economic opportunity. And we should get away from elite empowerment and listening to that elite far more than we listen to the needs and concerns of the vast majority of South Africans.
Great, thank you, Anne. I'm going to give each of you an opportunity just to make some closing statements, and I'd like to ask in the minute that I'll allocate to each of you, because we're about 2 minutes away from the top of the hour, to layer in what we shouldn't, what we should pay attention to that is positive for where we are, because it's easy to be cynical and frustrated. Just read the news or log on to social media, and it's an echo chamber of negativity in many ways. But where do you think are some bright spots that we shouldn't lose sight of? Please layer that into not too much to ask in the minute that I'll give each of you. Kaz, please share your thoughts.
Okay, so let me start with that. I think COVID has been devastating, but we've also, I think, there have been some positives of COVID. And without pushing too much social compacting and consultation and so on, because I've said decisions need to be taken, I think what COVID has done is it's brought together in a way that hasn't happened before some of the critical players in our socio-economy, okay? And it's also created a situation where so labor has been far more critical of government in the joint discussion than business has on some stuff, on state capacity, corruption, and so on. I think there's something for us to build there, not to take over the role of government and absolve government from taking the hard decisions. But I think that whether we like it or not, whether it's a historical thing or otherwise, our society, the South African society, works through collaboration and compacting and so on. And I think we need to structure those in a way that actually doesn't impact negatively on decision making, but does bring as many people into the game as possible. So I think that's the one positive. Having said that, I think that we need to absolutely, I'm fond of saying we're at a T-junction. We take the wrong turn, we're going into a failed state. We take the correct turn, we're on a long, hard road to recovery. I think we need decisive leadership from government right now because the levers do lie with them. And I think we get that leadership, we get that decision making, particularly from the president. I think it will unlock a lot of positive energies that will put us onto that long, hard road.
Thank you, Kaz. Anne?
Well, I think South Africa has a few things going for it. We have an excellent Reserve Bank, which had capacity to bring rates down, the left should remember, during the COVID crisis. So we have excellent leadership and a really world-class institution. We have a national treasury that is a real asset to the country. I think we're very lucky to have a committed private sector, not perfect, but a committed private sector that has been able to mobilize phenomenally. We can't find any examples of the private sector doing anything like what the South African private sector has done during COVID. This is a big asset for the country. I think the fourth thing is we continue to have an independent judiciary that, with a few exceptions, plays a remarkable role in our society. And by and large, the vast majority of South Africans accept rule by the judicial decisions and the rule of law. That's important. I think one thing that we never talk about is South Africa is unusual as a developing country in that we have a number of large cities. We're not like Thailand or even London in a way where everybody moves to one big capital city, and that has enormous problems for the society as a whole. South Africa has probably 4 or 5 functioning metropolitan areas, and we should build on that. We also have some secondary cities, a few that are functioning. We should build on that because after all, most of our economy is urban. So I think those are some of the assets South Africa has. I am a constitutionalist. I believe in our constitution. We have freedom of speech. We can argue with each other and debate where the country should go. This is not the case in many other countries. That's an asset for South Africa. So I think we do have assets, but what is missing now is the political leadership to take us out of the terrible cycle of decline that we're in on so many fronts, and to build a bridge away from despair and towards a vision and hope for South Africa, and that will require courage, boldness, and serious vision.
Thank you, Anne. We've covered a lot of ground today. What's clear is that globally there'll be tough economic conditions. 2020, 2021 will be lost years. COVID-19 is certainly going to ripple its way through the political environment and the commercial environment. Some comments came up today, for example, about the travel industry, which is in difficult straits at the moment. Africa, it does not operate in a vacuum and will not escape these difficult economic currents. The region will experience its first recession in 25 years. unfortunately, South Africa will be a laggard among those who recover if we make the right calls, at least until the end of 2024, before we return to 2019 GDP levels. Steeper declines when you take into account that our population is growing 1.6% or so per annum. To recognize the silver lining, I suppose, in the cloud, and echoing some of the sentiments shared by Cass and Anne, we have strong foundations and independent institutions to build on and leverage. Social partners are recognizing the crisis we're in and working together more effectively than perhaps they have in some time, if not ever. But we are, as Kaz put it, at a T-junction, and may we, the collective we, and particularly led by government, make the right decision of which way to turn. I'd like to thank all of the contributors today, Cass and Anne most recently, Simon who logged off. Thank everyone who attended the session. I wish you well, stay safe, and until next time, that's me signing off. Cheers.